Good morning, good afternoon, and good evening. Welcome back to the It's Attainable Real Estate Investing Show. It is episode 26. You've probably heard the word bullish on the market. If you haven't, it's an adjective. I can't believe I'm using the word adjective. I don't think I've used that since school. But anyhow, it's an adjective describing something. Usually it's describing the stock market or maybe the economy. And Webster Dictionary actually describes it or says it means optimistic about something or someone's prospects. So what is the something? It could be optimistic about the stock market, about the economy, or in this show, optimistic about real estate. I'm going to share a few reasons about why I'm optimistic or bullish on real estate.
Welcome to the It's Attainable Real Estate Investing Show, where you will learn about investing, the power of real estate investing, and how to invest in it. Whether you have the time or even if you don't, you're going to see it's attainable either way. And now your host, who always wants to share knowledge with you, Christopher Balcom.
The first reason is actually what the IRS, or Internal Revenue Service, the federal taxing entity here in the U.S., but the IRS calls real estate real property when you look at the IRS tax code. So real property is really reason number one of why I'm bullish on real estate. So real property, when I think of real property, it's tangible, it's physical, you can see it. And in a world that has become so virtual, if you desire, you can go by and touch it and walk through it. All of that means something. First, it means the structure itself is worth something. It's made of wood, it's made of steel or bricks. All that is worth something. Being real property also means that your investment in it doesn't just disappear. A business could go out of business, but the building that business operated out of is still there. You see that a lot today. The land the building is sitting on is still there. That's worth something. Now maybe you're pessimistic and you're thinking, well, it could disappear. The building could disappear. There could be a natural disaster or a fire or something like that. Well, for those items, the simple answer is the building is covered by insurance. So should those things occur, insurance will pay for the repair of the building or the rebuilding of the building. And if you structure your insurance right, it will also pay for the missed income that the building isn't generating while it's being repaired or rebuilt. So your investment is protected in that way. Reason number two that I'm bullish on real estate: multiple income opportunities. Real estate has a simple business model. Now, you don't have to run when things are complicated. I've been a design engineer for a number of years, designing complex and customized solutions for Fortune 500 companies around the world. But you know what I like? I like simplicity. The simplest solution to meet or exceed the needs of the customer is the name of the game. Sometimes there is a need for great complication, but when it's not needed, it makes it easier to understand. And because you and everyone else understands it, you can take action faster. Real estate at its core can be simple. It works like this. Income is based on lease agreements with tenants. The tenants pay the amount in the lease agreements. The managers or owners pay the bills and the expenses. And what's left over pays the owner and or investors if there are any. This is one income opportunity, and we call that cash flow or cash flow distributions if there's any part of it going to an investor. One of the expenses being paid is the mortgage on the property, assuming that it has one. As the mortgage gets paid down, you establish something called equity, the difference between what the value of the property is, which could be what you paid for it, what you purchased it for. Ideally, you paid a little less. So the difference between the value of the property and the debt on the property, which is usually the mortgage, is equity. So what does equity do? Well, if you were to sell the property, this is more cash you would receive upon the sale. But if you sell the property, you lose one of these income opportunities. You lose the cash flow. The cash flow stops once you sell the property. So you will have income from the property after you sell it, the equity that's there, but one of the income opportunities stops, and that's the cash flow. So here's where real estate really shines. Keep the cash flow and leverage the equity. You leverage the equity to buy another real estate property. Now you could take the equity and go on vacation or go to the mall or buy a car, build a mansion, so many other things. But if you're trying to build wealth, do what the wealthy do and take the income from one place and put it into another investment to make more money on the same investment. So you're probably saying, say what? Yeah, and just saying that, I feel like I might have lost you. But yeah, that's right. I'll explain more in an upcoming show. I'll draw it all out on paper. But here's what's happening. What you're doing is taking the equity, which covers all or part of the initial investment that you made into the property, and you go and invest that into another property. So your hard-earned dollars, or wherever your dollars came from, maybe you inherited them or they just magically appeared in your banking account. But these dollars, nonetheless, wherever they came from, that you invested in the first investment have multiplied into enough dollars for you to put into another investment while still receiving income from the first investment. It's like, or it really is, investing in a business to get up and going. Then after it's up and going, you get all or part of your investment back, and you take that investment that you got back and put into another business to get it up and going. Except you're still receiving income, or you're still being paid by the first investment. That is powered by what we call leverage. And it needs a whole show on its own, so it'll get it. All right, what's next? Remember when I said a few moments ago that the income from the property comes from lease agreements with tenants? Let's talk about that. Reason number 3 that I'm bullish on real estate. You are filling a need. Tenants either need a place to stay, a place to sell their goods and services like a storefront, or their food like a restaurant, or to store their goods like a storage facility, or if you have a lot of goods or products, maybe an industrial facility. You've probably seen or heard of the Amazon logistics warehouses and others being built here and there. Or maybe the tenant manufactures goods, so they need a building to build their goods, like cars or robots or whatever they might make or assemble. These are all tenants. Let's think about that first one for a moment. Tenants need a place to stay. That is a need that, well, everyone needs. We all need a place to stay. Whether it's a small place or a big place, a standard place or a luxurious place, whatever we feel our need is, real estate or real property provides that. A bathroom, kitchen, bedroom, and living space are minimal necessities, things that we're willing to pay for, and always will, unless somehow the government starts giving out free housing to everyone. Now, if you feel a need, solve a problem, your business will always be in good shape. Not many things are guaranteed, and I won't guarantee anything here either, but I feel pretty good about it. I guess you can say I'm bullish. I'm bullish based on facts though, and part of those facts bring me to the next reason that I am bullish: history. History is showing, I'm looking at an article right now that says, yes, over the last 2 centuries, about 90% of the world's millionaires have been created by investing in real estate. I've shared this message and similar before, but let us look at the actual data on real estate and real property as we talk about history. You can measure real estate in many ways, and if you do the research, you will find all types of metrics. I'm going to talk about a couple here so I don't take all of your time in one day. Let's look at rental history, so the cost of rent, and housing sales since about, since 1980. I think that's far enough back. 1980 to 2020, that's 40 years. Let's take rent first, since we're talking about income from lease agreements with tenants. And we'll stick to that first tenants who need or want a place to stay. So the monthly median asking rent for unfurnished apartments in the United States from 1980 till now, or at least until 2020. Now I'm just going to go 10 years at a time. So in 1980, the rent was $308. In 1990, it had doubled 10 years later to $600. In 2000, it was $841. In 2010, it was $1,077. And in 2020, at least January 2020, the median asking rent for an unfurnished apartment, so usually unfurnished is the opposite of like an Airbnb or short-term rental. So unfurnished would be your typical apartment you move into and buy or bring your own furniture. So monthly median asking rent for an unfurnished apartment in the United States in 1980, $308. And 2020, $1,742. That is crazy, right? I gotta figure out the percent on that. Give me just a moment. All right, that's 465% increase in rent. That is crazy. That's crazy for any type of anything, especially when we're talking about an investment. Okay, so if that's rent, let's take a look at home prices. In the United States, the median home price history for the last 40 years. In 1980, it was $55,000, or $55,074.15 is what the data really says, but we'll say $55,000 to keep it simple. In 1990, $97,000. In 2000, $132,000. In 2010, $182,000. And 2020, $273,000. Now, both of these numbers, rent and home price, are the median across the U.S. So you may be thinking in your area, well, rent's not $1,700 or home prices aren't $273,000 typically. Or you may be thinking that rent's a whole lot more or that home prices are a whole lot more. So this is median across all of the U.S., not just your specific area. That data is available also. I can point you in that direction if you want to see it. But this is, again, across the entire United States. So these numbers are just crazy. I knew that real estate increased year over year. We talked about that a couple shows ago, I think in episode or show number 24. But I did not know until I looked at this data that it increased that much. So from 1980 to 2020, the median home price increased from $55,000 to $273,000. That is a 397% increase. Again, a crazy number when we're talking about any type of percent, let alone an investment in anything. So real estate has history on its side that it typically year over year increases. And when you look at it over large spans of time, 10, 20, 30, 40 years, it increases greatly. Okay, reason number 5 that I'm bullish on real estate, and maybe by this point you are too. A break on taxes, a break or savings on income tax. When you talk about tax breaks or savings, I find there are 3 sides to it in terms of people. There are those that have tax savings and tax breaks and want to keep them. There are those who want tax breaks, and there are those who don't have the tax breaks. And for that last one, those who don't have the tax breaks or savings, or they don't think they do, sometimes instead of trying to get those breaks or savings, some I see frown upon those that have the savings. Now, we can all come together, and we'll bring everyone together right now and say, follow the IRS tax code the way that it is written. And if you need to, educate yourself or enlist the help of a financial professional who can help you. I'm providing education here, but for your own personal situation, seek the advice from a financial professional who specializes in tax. If you're here in the U.S., again, follow the IRS tax code the way that it is written, and you might find there's something there to help everyone, or help you get in a position to where it can better help you. If you're outside the U.S. or the United States, you'll of course have to consult your own taxation laws for your country. So, if you follow the IRS tax code the way it is written today, at least this is Q1 2021, you will find that it's pretty nice to real estate investors, or those who invest in or own or in some way receive income from real estate. Now, this isn't flipping that I'm talking about that you see a lot on HGTV, but I'm talking about investing in property where the income comes from tenants with lease agreements. The IRS treats this income differently than it does house flipping. Sort of like leverage, taxes could be its own show as well. I talked about taxes back in show 7, and I'll talk about it some now, but I'm thinking maybe we'll have another show where I'll bring on a CPA to give you all the nitty-gritty details about taxes, and they'll know a whole lot more than I do. But for now, again, the income I'm talking about comes from lease agreements with tenants. This income is firstly not like the income from your employer. The income from your employer, known as earned income or W-2 income, it's taxed first before the income gets to you, with the exception of a few items like healthcare or retirement plans like 401k or similar, maybe child or dependent care, pre-tax benefits, or commuter transportation, again, pre-tax benefits. But other than that, you know on your pay stub at the top there's a big amount, and then at the bottom or the check or the deposit into your account is usually a much different amount, a smaller amount. For income that comes from businesses, business owners listen to this already know this, and business includes real estate investments. It's different. Your income comes in, and then your expenses are paid, and what's left over is what you're taxed on. It works like this. So let's say income from leases were $2,000 for the month. After paying expenses, maintenance, lawn care, employees, whatever, well, I guess not exactly whatever. It does have to be a expense related to the business. But after you pay that, you've got, let's just say, half left over, or $1,000. So $2,000 minus $1,000, you've got $1,000 left over. That's the part that you pay taxes on, and you pay it at the tax rate that you would your normal earned income, whatever bracket you fall into with the IRS. Now, any interest from mortgages that are on the property would also be subtracted from that $1,000. So you might pay taxes on even less than that. Now, as I say this, I'm sitting here thinking, wouldn't it be nice if the check from your employer worked like that? You subtract your own costs, such as your food and clothing and your home, and then only pay taxes on what's left over? That would be the life. Well, it is the life for businesses, and your investment, again, in real estate is business. Oh, and I almost forgot, there's no FICA, so no Social Security or Medicare withdrawn from that income either. That's like 15% savings right there. I think it's like 15.3% or something, but that's huge savings right there. So your income from real estate, at least the income that comes in the form of lease agreements from tenants, is not subject to FICA or the Social Security or Medicare taxes. So as long as these tax savings or these tax breaks stay around, and history shows it has for some time, then this aids on a good outlook for real estate. It seems fair to me, in return for savings on income tax, you are, with your investment in real estate, providing people a great place to live, keeping the community in good physical shape by maintaining the property or perhaps improving it to be better than it once was. No one wants an eyesore in their neighborhood anyways. And your tenants will be happy because you are giving them a great place to stay. Now, you heard that right. There is maintenance and upkeep to the property because it is real property. I talked about the bricks and the wood and how things are built, what can make up the building structure. The manager or the owner needs to uphold their part of the lease agreement with the tenants as well, ensuring they take good care of this real property. This real property needs paint, it needs fixtures and repairs. All of that's an expense and tax deductible, by the way, as I said earlier. But you have to ensure that you are caring for that. Now, if you're investing in real estate and you're not a part of the day-to-day business, then you don't have to worry about this. But you should ensure whoever you're investing with is knowledgeable and competent in real estate and has people in place to take care of the property or take care of the business. Because if they don't, this will harm your investment. That I can guarantee. So what do you think? Are you bullish on real estate? Is it worth your investment? I think it's certainly worth a look because it's real property, number one. It has multiple income opportunities. It's a business that's filling a need. It has historical data to back it up that it's always on the upward trend. And it has tax breaks or savings to help out along the way too. But don't put off investing in it too long. As I was just sharing, real estate values rise typically each year. So what you can invest in today will cost much more tomorrow. And if you wait 40 years, it could cost you 400% more than it did today. But if you take this serious and get started today, then you can start getting that equity that I talked about that you can tomorrow put in your pocket or back into another investment. I hope this show was helpful to you. If it was, let me know. Leave a comment or a review on your favorite podcast apps such as Apple Podcasts or wherever you're listening to this today. And if you didn't like the show, let me know that too. If you have questions for the show, questions about real estate investing, or want to partner, let's discuss your goals and see if real estate investing is right for you. I'm at neelyrealty.com/engage. That's NILEE realty.com/engage. Lastly, and always, if this show was helpful to you, it might be helpful to someone else also. Don't keep it a secret. I'm sharing, so you should too. Share it with someone else, and I'll see them and you back here next time on the It's Attainable Real Estate Investing Show.
You have been listening to the It's Attainable Real Estate Investing Show, sharing transparent knowledge on investing and the powerful impact real estate investing can have on your wealth and lifestyle. Follow or subscribe to the show using your favorite podcast app so you'll know firsthand when a new show is released, or visit neelyrealty.com/podcast and see the show there. That's NILEE realty.com/podcast.